In this video we are going to talk about dividend stocks for passive income. So before starting this video, please like this video and subscribe to this channel for our future updates. It is passive income when you receive a regular paycheck from a source other than your job or a contractor. It is possible to earn passive income from two sources, according to the Internal Revenue Service, IRS rental property, or a business in which one does not actively engage, such as receiving royalty payments on books or stock dividends. However, in actuality, you may be required to perform some or all of the work upfront, but passive income is frequently accompanied by some additional labor along the way. Maintaining your product's current status or keeping your rental property in good condition may be necessary in order to keep the passive income flowing. However, if you are committed to the approach, it may be a terrific way to earn revenue, and you will also be able to build some additional financial stability for yourself as a result of your efforts. In light of the recent volatility in the stock market, having stock in a few dividend-paying companies would not be a bad idea right now. The passive income created by dividend-paying corporations may be able to help reduce the volatility of an investment portfolio by reducing the amount of money invested. When it comes to determining which dividend stocks to invest in, there is much more to consider than just the yield on the stock. While understanding how long a company has been paying and expanding its dividends is crucial, understanding how long a firm has been paying and increasing its dividends should also be considered when making a purchasing decision. The following is a list of the best dividend stocks to add to your watch list if you're brand new to passive income investing. Toronto-Dominion Bank. Toronto-Dominion Bank owning any of the major Canadian banks is a no-brainer for passive income investors looking for a steady stream of income. The Big Five all pay out high yields and also have some of the longest payout streaks that investors can discover on the Toronto Stock Exchange, TSX. The Toronto-Dominion Bank is the second largest bank in Canada, with a market capitalization of $170 billion. An increasing presence in the United States, which now accounts for nearly one-third of the bank's net income, is another strength of the institution. The company's expansion into the United States is expected to be a significant growth engine for the bank in the future years. When measured against today's stock price, TD Bank's annual dividend of $3.56 per share represents a yield of little under 4% on the company's shares. Investing in this dividend company is an excellent option for any passive income investor wishing to obtain exposure to the United States economy. Brookfield Infrastructure Partners. In addition to Brookfield Infrastructure Partners, passive income investors wishing to add some defensiveness to their portfolios should keep an eye on Brookfield Infrastructure Partners as well. Utility companies are among the most stable businesses in which to put your money. Regardless of the state of the economy, revenue levels in the utility industry tend to remain quite steady. At today's stock price, Brookfield Infrastructure Partners' dividend yields little more than 3%, which is a good deal. Northland Power Corporation. Typically, high-yielding dividend aristocrats have outlived their ability to generate returns that outperform the market. However, there are still a small number of firms listed on the Toronto Stock Exchange that can provide both a high dividend yield and growth potential that outpaces the market. Taking dividends out of the equation, Northland Power, TSX, NPI, has returned about 70% of its growth to its shareholders over the past 5 years, according to the company. In contrast, the S&P Wink with tongue sticking out /TSX Composite Index has returned only 40% during the same period. Including dividends, Northland Power has outperformed the Canadian stock market since 2017, generating returns that are more than double those of the market. A major reason why we included Northland Power on our best dividend stocks to buy list was the fact that we do not expect the company's expansion to stall anytime soon. The company has already established itself as a Canadian leader in the rapidly increasing field of renewable energy, and it is now concentrating on expanding its international footprint in the field. Northland Power is the firm to invest in if you are a passive income investor who is willing to forego dividend yield in exchange for growth. EPR Properties. EPR Properties is a specialist real estate investment trust that specializes in experience real estate, such as movie theaters and other attractions. While the REIT's portfolio had some headwinds during the pandemic, which resulted in the REIT briefly suspending its dividend, the REIT has emerged stronger than ever. Its monthly dividend was restored last year and subsequently boosted by 10%, bringing the current yield to approximately 6%, according to the company. That is significantly higher than the 3% average yield of the REIT sector and the 1.3% yield of the S&P Winkworth Sticking Out 500. EPR Properties should be able to increase its dividend payout in the foreseeable future. Several things lend support to this point of view. EPR Properties' dividend payout ratio for 2022 is 75% of its expected funds from operations, which is considered conservative by industry standards. It will be able to use the additional funds to fund new investments as a result of this. When combined with its robust liquidity position, which includes $288.8 million in cash and an undrawn $1 billion credit line, as well as its newly awarded investment-grade rated balance sheet, the REIT has the considerable financial flexibility to purchase additional experiential real estate properties. These prospective developments could help to enhance the REIT's income stream, which will allow it to raise its high-yield dividend, which should benefit investors in the coming years, according to analysts. Realty Income. Over the years, Realty Income has amassed a substantial amount of wealth for its investors. Since its first public offering in 1994, the retail REIT has grown its monthly dividend 115 times, including 98 consecutive quarters in the most recent fiscal year. Overall, it has increased its payment by a compound yearly rate of 4.4%, which has enabled it to generate total returns that outperform the market by 15.5% on an annualized basis. It is currently yielding an appealing 4%, which is quite enticing. With plenty of financial flexibility, the REIT can maintain and develop its portfolio, while also increasing rental income and dividend payments. The REIT has a healthy dividend payout ratio of 78.5%, allowing it to preserve some capital to use to fund future investment opportunities. Meanwhile, it has one of the strongest balance sheets in the REIT sector, with credit ratings of A+ and B+ respectively. Realty Income has the financial resources to acquire at least $5 billion worth of real estate this year, according to the company. The company, on the other hand, has lots of room to grow in the future. With billions of dollars worth of privately held commercial real estate in its primary regions in the United States and Europe, the company has an enormous pipeline of prospective acquisition opportunities. SL Green. SL Green Realty is an office real estate investment trust, REIT, that focuses on the New York City market, where it is the largest landlord of office space. In addition, the REIT has grown its monthly dividend for 11 consecutive years, and it currently has a yield of 5%. However, SL Green's high-quality properties have continued to be in high demand, despite widespread anxiety about the office market's long-term viability. The most recent quarterly results of the office REIT demonstrate that the Manhattan office market is regaining its equilibrium. Because of this, SL Green anticipates an increase in the volume of leasing transactions and rental rates this year. The Real Estate Investment Trust, REIT, is continuing to upgrade its portfolio by selling chosen office buildings and using the proceeds to support development and redevelopment projects as well as to buy shares of its own common stock. When combined with a strengthening office market, this capital allocation approach should allow SL Green to continue expanding its dividend and create value for its shareholders while also increasing its profitability. EPR Properties, Realty Income, and SL Green Realty all provide monthly dividends that are significantly higher than the industry average. Meanwhile, all three real estate investment trusts, REITs, should be able to maintain or increase their dividend payments in the future years. They should provide their investors with profitable and continuously increasing revenue streams, which, in the long run, could result in them making a large fortune. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.